Thank you all for joining this session, negotiating with investors. We are really glad and excited that you could be able to make time and join us for this session. We hope that after this session, you'll get a few tips and tricks on how to negotiate with investors. Just a quick quote from one of the people I admire. She says, "Everything is actually negotiable. The question is whether negotiating is easy or hard." So I guess that's what we are planning to learn in this session, and hopefully you'll be engaging the panelists and speakers that we have on this session. Feel free to stop us anytime by putting your question in the chat box, and we'll be able to address them. With that said, I have three speakers today who are seasoned investors and a seasoned investment lawyer who will be helping me to take us through this masterclass session, by giving us practical examples of how we can be able to negotiate different terms whenever possible. So with that said, I'll let Darren go first by introducing himself. Darren?
Yeah, thanks, Mercy. Hi, everyone. Thanks for joining the session. My name is Darren. I'm part of Avishkar Capital. We're an early stage venture capital fund, primarily investing in businesses across East Africa. So our country focus is Kenya, Tanzania, Rwanda, Uganda, and Ethiopia. We invest primarily through equity, but we can do convertibles if it's a bridge round. Primarily investing in Series A rounds, starting from as low as maybe $1 million, going up to 5 to 8 million over subsequent rounds of raising capital. A little bit about myself. I've been in the investment space for about 9 years now, with experience in India and East Africa. I've evaluated multiple businesses, but I'm still learning. So, pardon me if I get anything wrong during the session. But I'm looking forward to engaging with all of you. Thanks.
Thank you so much, Darren. On that note, I guess we'd go to Mary Joseph first.
Hi, everyone. Happy to be joining you all. I'm in the US. It's about 1 a.m. for me. So if you see me nodding off a little bit, please, give me some grace. I work with Greenhouse Capital. We are an early stage fintech-focused venture capital firm based in Lagos, Nigeria. We invest around Africa and also in the MENA region. In terms of our kind of sweet spot of investments, we typically do pre-seed and seed investments, and we kind of do equity, convertible debt, safes, whatever makes the most sense for the deal and for the entrepreneurs and for the startup. In terms of my background, I have kind of been in the African startup space for about 6 years now. Actually started my career in Kenya, working with some fintechs and microfinance institutions there before joining MEST in Ghana and advising startups. And then I joined Greenhouse Capital almost 3 years ago and have been working on the investment side. So I've kind of been on all sides of the table, from negotiating the deals to as a person in the startup to kind of offering the terms as an investor, and so hopefully I'm able to kind of empathize with you guys and kind of see it from both perspectives.
Awesome. Thank you, Mary Joseph. And then we have our investment lawyer joining us as well. She's the resident lawyer in this session. So Martha, kindly go ahead and introduce yourself.
Thank you, Mercy. Hi, everyone. Thanks for joining the session. My name is Martha Mbugwa. I am a partner and founder of Law 360. It's a small boutique firm in Nairobi, Kenya. Primarily, we provide advice in mergers, acquisitions, private equity, VC funding. We do advise a number of investors coming into Kenya, but we also advise startups. So we've seen both sides of the coin, and hopefully I'll be able to share a few things that might assist you if you're an entrepreneur or an investor on this session. Thanks for having me.
Thank you so much, Martha. So the masterclass would ideally be carried by all the four of us. As you realize, we have everyone represented in the spectrum. We have investors, we have the intermediaries as well, and we have, an investment on the speaker list. So really glad to have everyone join us. So probably we begin by, what's the standard investment process? I feel like that would be a fair place to begin, just to bring everyone on board, in case you do not have sort of, enough background on this. And I'll just ask Ariel to pull up the slides as well. Great, thank you. So the standard investment process looks like this. So first of all, when you have, interest from an investor, you'll have the first initial meeting, then they'll conduct, initial due diligence, and then issue you with a term sheet, and then they conduct further due diligence, and hopefully, the investment closes. So this is the standard way. However, every investor has their own method of actually, or their own timing on when they issue the term sheet. This process could easily go up to 8 months. It could also go as less as 3 months. And it was interesting to speak to an investor yesterday who said they actually close investments in a week. So that's really good. But the point really here today is, if we could go to the next slide, is that, when you're issued with a term sheet, really, it's the first, notable interest from an investor that they're actually serious about putting money into your business. So when they issue you with the term sheet, that's where sort of the negotiation processes begin, which is what, this masterclass would be focusing on today. So what exactly is a term sheet? So basically, a term sheet is a document that you're given by an investor that shows an intent for them to actually invest. It's not legally binding, but it's actually, intent to put in money in your company. That's when the negotiations between you and the potential investor actually begin. And it would articulate the terms and provisions within that the investor is actually willing to take. And after the term sheet has actually been negotiated and agreed upon, that's when you do get, the shareholding agreements or share purchasing agreements. But then again, as I said, it's not legally binding. You cannot publicly disclose this. Unfortunately, other entrepreneurs actually use this document to go out shopping for another deal. But really, this is, the validity of the term sheet is 30 to 60 days for you to give a no-go or, a green light on the term sheet. So a term sheet is typically divided into two. There's commercial terms and then there's control terms. So the control terms, let me start with the commercial terms. So the commercial terms would ideally stipulate, the amount that you're being offered. It would also stipulate, Ariel, if you could move to the next slide, it would also stipulate, the instrument that is being offered, the maturity dates of the investment, the interest payable, if it's debt, or if it's a convertible debt, and then the repayment terms and valuation. So those are the commercial terms of the term sheet. Then we go to the control terms, which is what we'll be talking about today, given that some of these are actually negotiated in a heated discussion. So some of these terms, some of the control terms are what we'll be digging through today. So we'll start with the first term, which is the valuation. Valuation is part of the commercial terms. Next slide, Ariel. So valuation is the first part of the is part of the commercial terms. And what really is valuation? Valuation basically stipulates the value of the business. But why should it be important to you as an entrepreneur? The reason why it should be is because investors would normally look at your valuation and then based off of that, take a certain percentage in your business or a certain shareholding within your business, especially if it's an equity, investment. So we have pre-money valuation and post-money valuation. Pre-money valuation basically stipulates the value of the business before the investment is made into the company. whereas the post-money valuations relate, the value of the business after the investment has been made. But valuation is really both an art and a science. The science part is actually, easy, while the art part is actually the harder part. The science part is, formulas, the three methods that we'll cover through today. But then the art side, which is, incorporating, how the team looks like, what are the patterns, how unique is the business, that's the harder part, because you cannot necessarily put a formula to it. So yeah, so there are three common types of valuations. We do have the asset approach. Ideally, this is where, the investor would focus on the assets of the company, and then deduct liabilities in the end to get the value of the business. We do have the market approach, which is, the use of multiples on your EBITDA or your revenue or your profit after tax. And then we have the income approach, which is the discounted cash flow method. Now, unfortunately for early stage companies, the income approach and the market approach is not quite often straightforward as we would like to think, especially because these are companies that have not yet started making revenue. And so they're really basing it off of many assumptions. So for instance, on the discounted cash flow method, which is why it should be important for you to actually develop a projection of the next 5 or 10 years for your business. If you do not have, the exact revenues, or you cannot necessarily tell how your cash flows are, then it would be harder, for early stage businesses, which is where the art part of valuation comes in. So an investor would then typically look at, how valuable your business is, and then give a valuation on that. So the reason you negotiate this term is because, again, as I mentioned, valuation has the ability to give, a potential investor, a shareholding in your company, and for instance, in terms of the percentage of shareholding you would normally get in an equity deal is, the amount invested divided by the post-money valuation. So if you do not necessarily agree with the investor on the valuation, then it has the potential for you to give them, high value in your business. So at that point, I would like to welcome Darren. I'll start with you, Darren, to give us, your experience with valuation and supporting entrepreneurs in, negotiating this term with entrepreneurs.
Sure. So thanks, Mercy. So before I come to valuation, just on the term sheet, right? Mercy mentioned that the term sheet is actually not a legally binding document, which is correct. It isn't, but there are two terms inside the term sheet that can be legally binding. One is exclusivity, and the other one is confidentiality, right? So those two terms basically are in the term sheet to sort of ensure investors are protected from the fact that they have invested time and effort and even money to sort of diligence this business, and you don't really go out shopping with this term sheet to other investors once you sign the exclusivity, and similarly the confidentiality, right? So the terms of this agreement need to be confidential. That includes the valuation, that includes everything, right? So once you sign those term sheets, it's really good practice to not break any of those two sort of legally enforceable clauses, and not shop. In good faith, if you aren't in agreement with some of the terms of the term sheet, you must disclose that to the investor up front, and then make it clear to the investor that you would like to explore other options, or not sign the exclusivity, right? So you can negotiate on that bit as well. So that's it. Coming to the valuation bit, I mean, as Mashi mentioned, right, it's very hard for investors to put a value to early stage businesses using any of the approaches, right? If you use the DCF, it doesn't work because cash flows are not predictable. one, because your revenues are unpredictable and aren't stable. So it's very hard to use the DCF and almost never used. Similarly, the multiple approach where you use industry multiples to arrive at the valuation, whether that's a revenue multiple or an EBITDA multiple or a PAT multiple, those also are hard to use because at an early stage you probably don't have an EBITDA, and you probably definitely don't have a PAT, a profit after tax, right? So very hard to use those multiples, and it then boils down to comfort factors, and stuff like how much are you willing to give away to the investor in terms of a percentage, and what is the investor comfortable with in terms of ownership in that company, and valuing the risk that he or she is taking at the time of entering the business versus the amount of capital that is being put into the business, right? So there's no thumb rule. You can't go into a discussion saying that, I know first seed rounds only dilute 15%, and I'm not going to move any more than 15%. There is no thumb rule. It really depends on what the value the investors bringing to the table in terms of furthering your business, the kind of capital or the amount of capital that's coming into the business, and the comfort level that you have as well, right? So there's no science to all of that, but it's all discussions and negotiations and getting to a comfort point or a middle ground that is fair to both the entrepreneur and the investor.
Thanks so much, Darren. Do you have, and I'll just move on to, Mary, do you have a specific example yourself of how you previously dealt with valuation, especially given that, you're from, entrepreneurial background into, investment background?
Yeah, so, I definitely agree with a lot of what Darren has already said of just the difficulty of, conducting evaluation for an early stage company, even as an investor, right? Because, and part of it is also, the market that we're working in. If you're looking at something like multiples, you would typically use, data from public companies in order to then compare against, private, small startups, but we don't have, a ton of startups that have gone public in Africa that we can compare against. So it does make it a bit of a tricky calculation. Something we've been able to do actually at Greenhouse is kind of comparing companies that we are looking to invest in to existing companies within our portfolio. So because we invest in fintech, a lot of our companies are, kind of in similar spaces, maybe doing things a different way, but in similar spaces. So we might be able to look at, a company in our portfolio that does lending and has been doing it, very well. And maybe we're looking to invest in another company that's doing lending, and we see some synergies or some similarities between their businesses. We're able to kind of say, okay, we actually have this data internally of, the larger or, older lending company. We can actually see what the valuation was for their last round compared to what their revenue was at the time, and use that. We'll use that multiple actually to compare against the younger company, or if we're able to do even a DCF, we might do that. But yeah, it really kind of depends on the stage of the company. Even what I've just described would really only work for a company that does already have some amount of revenue or some amount of traction. When we're looking at companies that are pre-revenue, pre-launch, it's really kind of a gut feeling. It's looking at, what the rest of the market is looking like. If they come to us and they're like, well, we think we're worth 10 million, we're like, well, why do you think you're worth 10 million? You haven't sold anything yet. So it's really kind of about just something I'll also add actually is our partners are entrepreneurs themselves, and they've just been in the space for very long. So for them, there's almost like gut feeling that also enables us to kind of navigate these waters. But I can let the entrepreneurs in the room know that the investors might be just as confused or unsure as you are.
Yeah, Martha, do you find such instances often, confusion in terms of valuation?
Well, actually, nobody asks lawyers anything to do with valuation. They usually present the numbers to us and instruct us to draw the documents. One thing I'll add to what Darren said about term sheets is that, yes, they are non-binding, but one additional thing that you need to know as an entrepreneur is that you might find a break clause in there that is binding. So it's important as an entrepreneur to be sure once you're signing a term sheet, break clause means that, or break fee means that if the deal doesn't go to signing, then you might, be responsible for some of the costs of the investor. So you need to be careful when you're signing a term sheet that you're comfortable with that investor. So as I've said, valuation, usually the lawyers don't get involved. Our role, however, when it comes to the price, is to get instructions from the parties on the price per share, whether the target at the moment has available shares to be issued, whether those shares will be issued at par value plus share premium, and what the stamp duty implications of that are. So I find that a lot of entrepreneurs may not have taken accounting and tax advice on how they should structure their cap tables. This is something you need to do very early before you even get involved with an investor. You need to understand that once you've set your price, there's various steps that as lawyers would have to do to give the investor, the shareholding that they are investing for. So you need to understand issues such as stamp duty, share premium, nominal or par value of your shares, so that we as your lawyers can help you draft those documents and make the relevant filings at the company registry.
Great. Thank you so much for that, Martha. So we'll move on to our next term, which is the anti-dilution term. Basically, this term in the term sheet protects investors from, a future down round. What I mean by a future down round is, if you do issue shares, or if you do, if an investor comes in, at a pre-money valuation that was actually lower than the post-money valuation of the previous round, meaning it actually protects the investors from the risk of getting new shares at lower prices. And often this term is actually put in the term sheet to motivate you, the entrepreneur, to actually perform well, so that the pre-money valuation of the next round is actually higher, so that this term cannot kick in. You usually want to negotiate this very, very carefully, because sometimes it actually can dramatically increase the shareholding ownership of an investor in your company. So for instance, there's two forms of, anti-dilution, terms. So for instance, you can, the investor can go full ratchet, or they can take, the weighted average. So the full ratchet is honestly, the shareholders basically have the right to buy shares at new prices, at the new price that the shares were issued at, whereas the weighted average sort of gives the shareholder the right to purchase the shares at a price that accounts for the change in the old share price and the new share price. So what do I mean by when I say full ratchet? Really, so for instance, think about a scenario. So if a preferred shareholder actually bought in, in your company for $1 a share, and then, down the line, the down round occurs, and so you issue your shares at about $0.50, then the preferred shareholding price would then convert in that specific price point, which is $0.50. So meaning the preferred shareholder would now hold 2 common shares. So yeah, so if you look at that, they've not put in extra money, but they're having more shares in your business. Whereas the weighted average sort of tries to account for the change in the price of the change in the price for the new price shares, and then the old shareholding. So I'll start with Martha. In terms of the full ratchet, what have you actually seen in the market in terms of this anti-dilution term?
I've seen someone laughing about the full ratchet terminology in the chat box. It's an interesting term. This is obviously a bit punitive for a founder. I think it's more common in early stage where investor is taking a chance on this founder to really get them to make their investment worth it. So it's more common with early stage, but it's definitely very punitive for the founder because it pretty much means that the founder will be diluted significantly in subsequent rounds. So it's not advisable. If I'm a lawyer acting for a target, I would try and push back on this and try and advise the founder to get the weighted average or any other anti-dilution protections. Now, the problem here is that a lot of people don't come to their lawyers during term sheet stage. They come and present the document to us and they ask us to draft, and some of these issues then arise. So what we try to do in drafting is mitigate whatever it is the founder has agreed to. For instance, by limiting the period of the full ratchet. So it's only applicable, for instance, for a year or two or up to the very next financing round, and then it drops off, because if it's a permanent right that the first investor has, then the founder just continues to be diluted every time there's a round. So that's one example. There are various other examples, but if you want to know them, then you will have to get in touch with me directly on how to mitigate this full ratchet.
Okay. Martha, have you ever mitigated this full ratchet before?
Well, I've been lucky to not come across it because most of the time I have acted for more mature startups, and so they usually do not agree to this in the first place. But I'm aware of it, and one of the ways to mitigate it is to limit it in time. Another way is to try and get an assurance from the investor, because other investors coming in will also be concerned by this kind of an anti-dilution protection. It's very favorable to the very first investor. It's not favorable to other investors who will be coming in, unless they ask for the same thing, which is very detrimental to a founder. So I've not really encountered it in this market, maybe because I've not done a lot of work for early stage startups. Most of the work I've done has been for mature startups, and they usually don't agree to the full ratchet.
Okay. And Darren, from an investor's point of view, would you advise full ratchet or weighted?
So, Mercy, I think, when you're looking at the term sheet, you can't look at clauses in isolation, right? You can't just pick out the anti-dilution clause and look at it in isolation, or liquidation preference, or whatever you encounter in the term sheet, right? You have to look at it as an entire package. And what are you getting in terms of that package? And in some instances, founders are very bullish on one thing, right? And most of the times it tends to be valuation. And they want a high valuation, they want it to be, X, Y, Z or whatever, right? So the way investors mitigate that valuation, sometimes, and so the other thing that it's a winning and a losing battle across many terms, right? So some you win, some you lose. And so sometimes the investor lets it go on the valuation, and you say, okay, fine, you won $5 million, take it, go, run with it. But then they will hold you down to something like the full ratchet if your business is not sort of proven, revenue traction is not proven, because they want to protect themselves in a future round where they don't know if the valuation in the future round would actually exceed 5 million, right? So in that instance, the investor might be bullish and say, no, I want the full ratchet in. And from a founder's perspective, you need to know which battles you need to take up, right? If you won the battle on valuation, you can still try fighting out the full ratchet. Maybe you win that as well, but it's a give and take, right? So my experience is that, you win some and you lose some inside the term sheet. And sometimes when you win a high valuation, investors, especially at the early stage, might want the full ratchet in there, just so that they're protected in the next round, because they actually gave into the valuation ask in the beginning.
Great. Mary, is this your experience as well?
I actually personally never really utilized this this method, so I can't speak on it as well as Darren has. But I would agree that you have to kind of look at the negotiation as a full deal, and especially as an entrepreneur, you should going into any negotiation, you should kind of determine what are your deal breakers, what are your no-go zones, and what are things that you're willing to be flexible on, and that'll help you kind of plan as you're negotiating. So if you are open to a full ratchet, but within reason, know that ahead of time so that you're prepared as you go into the as you go into the negotiation.
Great. All right. So
Mercy, just that being said, I mean, the best case scenario for entrepreneurs wearing the entrepreneur hat is obviously the weighted average method, and you must try to negotiate to get that in. But as I said, it's a give and take.
Yeah. Understood. So we go to the next, term, which is the liquidation preference. Basically, this is, the right that allows the investor to actually recover their investment during when liquidation is triggered, or when the company is winding up, or there's a merger and acquisition going on. So basically, there's three methods of when this liquidation preference can actually kick in. Usually the first is actually most favorable to the entrepreneur, which is the straight preferred, meaning upon liquidation, or when liquidation is actually triggered, the preferred stakeholders would actually be entitled to a return of the entire investment plus any dividends that have been accrued. So obviously that's preferable to you, the entrepreneur. However, what's preferable to the investor is actually the participating preferred, which actually means, the preferred stakeholders shareholders would be entitled to a return of their investment plus accrued dividends. And over and above that, they would also participate as common shareholders, meaning, the dividends would again be split, ratably as well. So that scenario is actually what we call the double dip, meaning, they're actually getting their money twice, for lack of a better word. But for you, I think in terms of negotiations, there needs to be a middle ground, as Darren has mentioned. You win some, you lose some. So usually, entrepreneurs would settle at a capped participating preferred, meaning it's usually a mix of the two. So it's usually a mix of the two, meaning, you would the participating would kick in, the participating preferred would kick in, but then the return is actually capped, and once the preferred shareholders have actually received the capped amount, then they no longer have a right to to the remaining proceeds of common shareholders. So in terms of negotiating, and I'll probably let Martha take this as well. There's usually the multiple effect, where the concept of the multiple, where it means where the preferred shareholder is actually entitled to a multiple of the original investments that they had actually brought into the company. So you actually need, as an entrepreneur, you actually need to look out for that. And I'll let Martha take this as well, in terms of how best, from an entrepreneur's point of view, how best can they negotiate this liquidation preference term.
Okay, thank you, Mercy. As mentioned, obviously the straight or non-participating preferred is more favorable for an entrepreneur, and so we would advise you to try and push for that as an early stage startup. But of course, for the investors, they prefer the participating preferred or the capped if they're able to agree on a cap. For the non-participating preferred, you'll find that we'll recommend that you try and have in your agreements, your term sheet and your substantive documents, the investor having the option to either exercise their liquidation pref or convert their shares into common equivalent shares or ordinary shares during a liquidation. The first thing, though, is to define what a liquidation is, because you might find that for more mature startups or more valuable startups, that you can limit what a liquidation event is, for instance, to a listing or a full exit by everyone, rather than various rounds coming in the future for early stage. So the first step is to define what the liquidation event is. And second is to try and get a more preferable type of participation by the investor. Now, if they choose to have the two options where they can convert to common shares, what you need to watch out for is the rate at which they're converting, because that's another trick where they might end up in the same place as the double dipping one that I think Darren is going to be speaking about shortly. So there's a few things that we can do there. Again, for an entrepreneur, either you're very experienced with these terms and you're able to negotiate them by yourself, or you preferably, get a lawyer to help you mitigate some of these terms, because even though we've said in the beginning that term sheets are non-binding, they are sort of an indication that this is how the substantive documents will be. So trying to wiggle out of them later could be difficult and could get the investor to go away. So that's what I would recommend on this one.
Yeah. And Darren, isn't double dipping sort of, a disadvantage to the entrepreneur?
Well, I mean, you have to look at it in the whole light, right? Investors that, sort of take a bet on an entrepreneur early on feel the need to be compensated for actually backing that entrepreneur when no one else did, and therefore would want to be rewarded at a time when that entrepreneur or that business is actually selling out or getting a windfall, right? So the double dip is there to actually ensure that the investor is sort of getting the upsides of him or her participating in an early stage, right? So again, it depends on the negotiation with the entrepreneur, the stage of the business, etc. The other thing that you would want to look at also is the 1x or 2x of the liquidation preference, right? So the usual number is 1x, so investors should get the money that they put in, at least. Sometimes you might find investors putting 2x into the term sheet as well, and again, the reasons for that can be many. The risk involved, the high valuation given out to the founder and the company, and maybe lack of trust, whatever, right? So you should look out for that, and I think 1x is something that you must try to agree on, and it's not everything that you'll win, as I said earlier as well. So try and push for 1x. And as Martha mentioned as well, right? A liquidation event is not just a folding up of the company, right? It's also a merger or an acquisition event that can be a very profitable event for the founders, which investors want to also sort of get the upside of, which is why the double dip is in there, right? So a liquidation event needs to be defined clearly in your agreements, and then therefore negotiate the multiple and whether the double dip stays or goes.
Right. And to you, Mary, what would be your experience with this specific term?
Yeah, I mean, real quick before I answer that, I just wanted to add on that, rather than even thinking about this term or this method as being disadvantageous for the entrepreneurs, I actually even see it as being more disadvantageous to like later investors that come in and wouldn't necessarily have may not have these preferred shares, or because they didn't come in early and didn't take on that risk. So yeah, I think it's just about the entrepreneurs really just kind of understanding what the purpose of these terms are. It's not these terms aren't here to, or not these terms, but these methodologies aren't here to disadvantage the entrepreneur, or like, investors aren't like out trying to like take advantage of you. At least they shouldn't be. And if you get the feeling that an investor is trying to take advantage of you, that's a red flag for you to not do that deal with them, right? So, I think that there is an element of just assumed goodwill between parties until proven otherwise. And so I think assume that the investor is kind of looking out for you. Also, obviously, they have to look out for themselves and look out for their LPs. But I think in my experience with this, it's really just about being kind of open and honest. As an entrepreneur, definitely do your research and understand what the double dip means, and if you ideally have a great modeler on your team, or you can get someone to help you and kind of just do a quick outline of what that could look like in the future, and look at different scenarios. I think that can help you kind of visualize what it would actually look like, and help you as you negotiate that.
Great, thanks for that. So we move to the next one, which is, the promoter lock-in and vesting. Usually the reason for this term is because in the early stages of a company, the investors tend to bet on the jockey and not the horse. So they bet on the team that actually is leading the business, instead of the potential that and actually bet on the potential that this team has to actually make the business a success. So for the lock-in term, it actually just means that you as the founders cannot necessarily dispose any shareholding for a specific period, until the lock-in period is actually over. And if you do, then the vesting, the vesting kicks in, the vesting formula kicks in, where, some entrepreneurs actually view this as investors trying to control them within the company, but really it's because they've actually bet on you, the company, the team that's running the company, rather than the company itself. So on that note, I'll take it to Martha to take us through her experience on what the promoter lock-in means in this market and for the entrepreneurs.
Right. So, I mean, obviously, from an investor's perspective, they're really investing in you, especially at an early stage. So one of the conversations we'll always have with targets when we're representing them is, what are their goals? And are those goals in line with what the investors' goals are? Because investors have an exit period. So, they have to leave at some point. But do you want to work with them up until when they leave? Or do you want to leave before them? And if that's the answer, there might be a bit of a misalignment there. A lot of all investors will usually ask for a lock-in period. So your only avenue is to decide for yourself, how long do you want to be in this business? And if you want to exit, earlier than the investor, have you built a team that the investor is comfortable with, or is the business just you? I don't advise that you, overly negotiate lock-in clauses. I think, agreeing on the period makes sense. So most people will ask for 5 years. Others might ask for 8. They might ask for more. It depends on what period you're comfortable with. But I think if you're overly negotiating this period, any investor will be concerned, because they'll be worried that you're planning to exit as soon as the money is in, and then there's no one to run the business. But in terms of vesting, and there are some situations where we would say, okay, maybe negotiate for, in case, ask for good leaver, for instance, provisions, where you might have to exit the business in an active role for reasons beyond your control. And we can define what those are. But, trying to, get out of the business when you're the one who's leading it, I don't think is advisable. But asking for, a way out because of extraneous circumstances, maybe you're sick, ill health, or personal issues, which ideally, those should not be, then maybe that can be discussed with the investor, and those can be included in the document. Otherwise, be ready to be in there for the long run. I think everyone is betting on you, and if you love your business, you wouldn't want to leave it either.
Yeah, yeah. Mary, your experience?
Yeah, I mean, I think that is completely accurate. I always say, especially at pre-seed seed rounds, your business is going to change. You can do evaluation and project your cash flows, and your business model might change in the next 6 months, or even less. You might see changes in the market and pivot accordingly. But what we're betting on is that you, as the entrepreneur and your team, are going to be able to kind of see, identify what those changes are and make them accordingly in order for the business to succeed. So it's definitely a red flag for us if we see that you're already kind of trying to negotiate your exit before it's even started. And there are horror stories, not horror stories, but there are stories of entrepreneurs that have raised and then they exit and go do whatever else, and the company fails, and the investors are kind of left to pick up the pieces or try to find someone else to run the business. So I think that's definitely one of the biggest fears of as an investor, and that we want to avoid. The other thing that I'll say though is that the vesting agreement, I think, is also good for you as an entrepreneur and for your founding team, right? Because it also ensures that you're not left alone. It ensures that the other people on your team are also, everyone is being held accountable, that you all have to stay for a certain amount of time and put your all into the business, and you only get your equity only vests after a certain amount of time based off of certain milestones or achievements. So it also protects you as an entrepreneur. So I think that when you're starting your company, definitely have vesting agreements between yourself and your co-founders, and that can be the basis upon which the vesting agreement with your investors is built, or the vesting terms.
Darren, anything to add on that?
Yeah, just one thing on the vesting, right? We investors usually have the vesting schedule in there for, as Martha was sort of alluding to, good levers and bad lever sort of circumstances, right? So all of that will be defined, but just to give you a flavor, what is a bad lever, right? A bad lever, it typically is a founder being terminated by the board because the founder has done some fraud or participated in business activity that is not permitted, or siphoned off some money, etc. Right? So the board then decides to sort of terminate that founder's agreement with the company because of what he or she has done. And then how does that founder get rewarded, or why should that founder be rewarded for causing that fraud, right? And then vesting comes in to sort of mitigate that. So what vesting does is, even if you've been with the company for 2 years, after the investment has come in, you might not necessarily hold ownership over all your shares. You might just have 25% ownership or 10% ownership because of the vesting schedule. And in that case, the investor is then protected, and the founder has to exit with only 10% holding of that share of his or her shareholding, based on what is vested up to the point of the fraud or the negligent activity that the founder has done, right? So vesting schedules protect investors from things like that. And obviously, in a good lever scenario, when you are terminally ill as a founder or meet with an accident and are completely disabled, hopefully that should never happen to any of you, but those can, right? So in that situation, investors want everything to be vested quickly, the shares to be disposed of to the company or sold back to the company, and then the founder can move on with some level of wealth that is created and take care of him or herself, right? So vesting schedule is important for those scenarios where there's a good lever scenario or a bad lever scenario, and it's important to know, to have that in place from an investor's perspective.
Okay, great. Thanks so much for that, Darren. So we move on to our next, term, which is the right of first refusal, and then the right of first offer. The right of first refusal basically gives the company to offer the investor in the company the right to actually purchase the shares before offering those to a third party buyer. And in this case, which I'll let, I guess, Darren take this, what entrepreneurs can actually, negotiate on. For instance, they can negotiate on the threshold limit, and then they can also negotiate on the number of shares that the investor can purchase and the rights. But that's on the right of first refusal. And then the right of first offer would require the investor in the company when they want to sell to actually offer the founders and promoter the first right, but they're not necessarily obligated to purchase all the shares for sale. So I guess, Darren, you take the right of first refusal and what your experiences has been with this particular term.
Yeah, so the right of first refusal typically only kicks in once the lock-in period is expired, right? Otherwise, by the very definition of the lock-in period, a founder is not allowed or permitted to sell his or her shares, right, in the company. But what sometimes investors do to provide some liquidation or liquidity to founders is that they give them, some 5% or 2% to be able to be freely traded, obviously with the approval of the investor. And that's when those are the shares that can be sold before the lock-in. But right of first refusal usually comes in only after the lock-in period is expired, and essentially gives the investor the option to sort of subscribe to those shares at the price at which the founder is selling. Now, this is sort of a secondary transaction, so not necessarily needs to be priced at the existing price. It depends on what the founder needs. If there is, a really urgent need for liquidity, household issues, children want to go in for education, whatever, many things can happen, right? So you price the shares accordingly, and what you believe they're worth. Then the investor has the right to purchase those in a ratio that they hold shareholding in the company as well, right? So they may not necessarily be allowed to buy all of those shares. They can buy it pro rata.
And then
it's a standard clause. You need not negotiate or fight too much about something like this.
Yeah. Martha, would you say the same applies for right of first offer?
Yes, I mean, this would be beneficial for a founder that before the investor, goes out there to sell to a third party, that they give you the right to make an offer. Of course, you have to be ready then to afford to buy out the investor. So putting in some sort of mechanism in your shareholders agreement as to how your shares will be valued, I think is extremely important for you when you're asking for this right of first offer clause. But as Darren has said, these are not really clauses to negotiate out of. You just need to understand how they work and how you can use them to your benefit as an entrepreneur.
Yeah. Any advice for the entrepreneurs on how they can use this to their benefit?
Yeah, so we've actually done, a couple secondary transactions like this where, might be a company that we've held for a while, or the entrepreneur has been in for a while, and they're looking to, maybe not, exit fully from their shares, but, actually get a substantial return for the work that they've put in. And we as an investor might be wanting to kind of, double down on our investment and actually put in a greater stake or acquire a greater stake because we see how successful the business is. So this can often be a win-win. I think also for entrepreneurs, this is a way for you to kind of, sell shares in your company without necessarily diluting other investors, which can, kind of create some tensions. And so it's a way for you to kind of, inject more capital, exit yourself, without bringing in more investors, without diluting. So I think it can be a good cost for everyone. Again, if ideally you like your investors that are on board, you have a good relationship with them, and so if you're selling shares and they want to kind of acquire that additional stake, it should be kind of beneficial.
Great. So we move on to our next one. And please feel free to post all your questions in the chat box. We'll take them after. But the next sort of rights in the term sheet that you'd come across is the affirmative voting rights. Basically, these are usually rights that are demanded by investors, especially when it comes to matters that affect their interest or return in the end of their own investment. So mostly it would be called veto rights, sort of, or creating a super board, but otherwise these are rights, voting rights that the investor has a say upon before you actually act on them. So some of them could include when you want to sell a company, or you're hiring a key person in the team, or you want to change the projected budget over a certain limit, etc. So I think these are pretty standard, and investors would ideally want to have a say in some of these decisions. But I'll let, I guess, Martha take this first. What has been your experience with some of this, rights?
So this one can actually be one of the ones that, if you don't look at it carefully in the beginning, could lead to a bit of a stressful relationship with your investor going forward. I think this is something you have to really pay attention to. From an investor's perspective, they are concerned that certain decisions could affect their investment or the value of the business. So this is where they are coming from as an investor. They're putting in their money. Yes, they are probably a minority shareholder. And because a majority shareholder can do quite a lot without restraint, this is why these provisions come in. Now, the first thing to know is that even in Kenya, from a regulatory perspective, where an investor is getting control over your business by way of decision making, you have to make sure that you get an assessment from a competition law perspective. We've come across very many scenarios where investments have been made and parties did not check whether they were supposed to notify or get certain approvals from the competition authority. And then that puts your company and the investment in a bit of jeopardy as far as whether it's compliant legally in Kenya. And various other jurisdictions, I'm sure, have similar provisions. Some have higher thresholds for reporting, others have lower ones, like in Kenya, although they are trying to increase those thresholds. The other thing you need to look at is, can you negotiate a sliding scale, so to speak? So if the investor holds a certain percentage, then they can have those rights. But when they drop down to a certain level, then maybe some of those rights fall away. Another way that can, help you negotiate this is, ask for the thresholds to be checked. So for instance, if they're saying you cannot, for instance, spend more than X amount without their consent, what is the amount? You want to try and get the amount as high as possible so that management is able to, do their day-to-day without having to go back to the board or to the investor for them to run the business. But what is the amount? You have to be reasonable. You can't pick an amount from the air. It has to make sense as far as your business plan is concerned, what that amount is. If it's key staff that the investor is insisting that they want to be able to appoint, most of the time it will be the CFO or the ops COO. Why would you object to that unless you have someone better? So you have to think it's a give or take. You have to understand what the investor is trying to do here. They're trying to protect themselves, but you also want to see whether you can some of those rights can fall away if they drop in subsequent rounds in terms of their shareholding. Those are some of the strategies we've used to negotiate it. But definitely, usually very tense when negotiating this, especially for on behalf of a target. And that's why I mentioned, the earlier you bring your commercial terms to us as the lawyers, the better, because during substantive discussions, it's hard to wiggle out of what you've already agreed to in your term sheet.
Right. Mary, would you want to add anything on that?
No, I don't have too much to add. I will say definitely as an investor, we look at this a lot because we want to make sure that as the company, continues, we don't get, especially for an early investor, that we don't get, pushed out too much in terms of our, I want to say control of the business, but influence over the business, I guess, and ability to make recommendations and things like that. So this is something that is very important for investors and may take a longer time to negotiate.
Okay. Darren, anything to add?
Yeah, I think what is key to understand here from a founder's perspective is the intention, right? Why is this clause in there? What is the intention of the investor to have this in there? And I can say it for us as Avishkar and for most investors, the intention is not to run your business. Investors wouldn't be, in an investing role if they wanted to run businesses, right? So they really don't want to run your business, and you must understand that. And I would say that for most investors, there can be some who want to run your business. I don't know, but most investors don't. And the other reason is to keep things under control, right? Many founders are raising their first rounds. Many founders are sitting on cash pools of $2-3 million, which they probably never had access to before, or never managed P&Ls, or never managed treasury, as you would say, for a company, right? So this is a mitigant. So to ensure that founders are doing the right thing, they're not spending unnecessarily, they're not incurring unreasonable ad spends, unreasonable salaries, things like that, right? So it's a way that investors sort of mitigate the risks of founders being completely new to handling this kind of money and putting some checks and balances in place. Obviously, as Mata mentioned, many of these caps in thresholds of salaries or thresholds of expenses, etc., should be sort of clearly articulated, and you must arrive at a number or a range, if not a fixed number, a range, so that you don't have to go to the investor if you're buying a laptop or going to incur some expenses on refurbishing the office space or things like that.
Yeah, and on the same breath, Darren, could you speak about the boardship representation? How many seats can an entrepreneur give, etc.
So that's not a fixed, again, it's not a thumb rule, right? It depends on what the board composition is, and in early stage businesses, in your first round, it's typically the founders that have majority on the board. So if it's a three seat board, there may be 2 seats for the founder and 1 seat for the investor. In subsequent rounds, you might have equal number of seats for the founders, an equal number of seats for the investors, and then an independent, so that the votes can actually be split and there's no deadlock. Right. So it depends on the stage of the business and the composition that the investor feels comfortable and the entrepreneur feels comfortable with. And sometimes these affirmative rights are also there in place so that when an investor is not participating on the board, they have these rights to sort of mitigate the fact that they're not there on the board and board decisions are not in their control. But these decisions are, and these are essentially decisions that get voted on at the board level. So it's a balance that the investor is trying to play. Sometimes you might give off something over here. The investor might give out something over here and say that, okay, I don't want to make this an affirmative right, but know that it will come to the board for voting, and then the investor sitting on the board any which way, right? So he or she is going to take a decision at the board level. So it's a mix and match between board rights and affirmative voting rights. But yeah, there is no thumb rule for board seats. It's a comfort thing and a stage thing as well.
Great. So, and then lastly, we'll talk about, the exit, right? So yeah, so there's different ways that an investor can actually exit the investment through mergers and acquisition, as earlier alluded, through partial or full exit, through secondary markets, management buyout or IPOs. There's many, I guess, IPOs are quite rare in this market, and Darren and Mary can feel free to correct me there, but they're quite rare in this market. Of course, some of them have happened, but quite rare. Management buyout, where you buy out the investors, etc., etc. But the rights that actually apply during exit is, the drag along rights, which basically gives the majority shareholders the right to force the minority shareholders to sell their shares, especially in cases of acquisition. And I'll let, I think, Mary take us through that one first. But ideally, investors would fight really hard to get this because they deem this necessary to just ensure that, they're able to exit their investment in the end. But you as an entrepreneur, you can also negotiate on the minimum sell price that this right can kick in and the investment period of which, this right has to kick in. So on that note, probably I'll let Mary take this one first in terms of what drag along rights are and what has been your experience there before we move on to the tag along.
Yeah, sure. So yeah, I think this one is super critical because as an investor, you don't want your money to be tied up forever, right? The goal is to put the money in and get it out after a certain amount of time, typically maybe 7 to 10 years, depending on the market. So you, as an investor, you don't want to be in a situation where, a company that you've invested in has an acquisition offer from a larger company and, an investor who owns 2% has decided they don't want to sell their shares. Therefore, the company can't buy them, or the founders don't want to sell their shares, even though it might be a great opportunity. And so, this is really, it's really a mechanism that means that, after a certain amount of time, if there is a good opportunity for an exit, investors can kind of push the company to take that. So we haven't had any acquisitions yet in our portfolio, but there have been, we've definitely had conversations around this. And, I think that it can sometimes actually create friction more so between or not more so, but it can create friction between investors. So I think it's important that these terms are very clear at the beginning so that when it does come time to facilitate the exit, it's not a surprise to any minority investors that the drag along right is there.
Mm-hmm, mm-hmm. Darren, your experience with drag along?
I think it's a hard to enforce clause, to be honest, really. If in the practical sense, it's very hard to force an entrepreneur to sell his or her shares. It will eventually and invariably end up in litigation, and you have to have a court decide on the matter. Obviously, everything is in the investor's perspective, because it's captured in the terms, it's captured everywhere. But courts sometimes, side with founders for multiple reasons, right? But it's an invariably sometimes gets into litigation, and it's not an easy thing to pull off in the real world. But investors need it in there, just because it protects them from the downside of not being able to liquidate their shareholding. And you must understand why investors need exits in the first place, right? Yeah. Investors are temporary managers of capital. It's not their money, it's someone else's money. Investors have gone out and told that we will bring you X amount of return in X number of years, right? So they have a fiduciary responsibility to return that capital. And I'm talking about commercial investors here. I'm not talking about philanthropic investors. They may not necessarily have all these requirements, but commercial investors raise money from other commercial investors and have a fiduciary responsibility to return that capital. And therefore, it becomes binding on the company to return capital to the investor once they take money from them, right? So drag along is really important so that it's in there. But as I said, it's hard to, if it's going down to that to that recourse, then you're probably having a very sour relationship with the investor, and you're not able to agree on agree on the way forward, and that's when it will get into litigation, and it's not pleasant for either parties. So it's better you get to an agreement before, but yes, sometimes it's hard to do that.
Okay, I'll just quickly do the tag along and then I'll let Martha take both. So basically, the tag along rights sort of allow the investor, the option to sell their shares in case specific shareholder or a specific shareholder, decides to sell their shares as well. Generally, usually the co-founding team, and this one sort of closely relates to, the lock-in investing. So Martha, your experience with both tag along and drag along.
Well, my experience once with a dragged along clause where we were acting for our target was quite interesting. Definitely a hot topic. No founder wants to be dragged in a sale when they're not ready to leave. But by the time that is happening, as Darren has mentioned, is probably already a problem. So I think as long as the founder understands that, an investor needs to exit, and you have to, create an enabling environment for that so that they don't have to resort to the drag. But how do you protect yourself as a founder in relation to a drag? You could ask for a period where they cannot enforce the drag. So you could ask for a lock-in period as well. You could restrict who they can drag you to. So one example where, we had quite a hotly debated drag clause was the founder did not want to be dragged to a competitor, for instance, that a competitor would acquire his business. So there are ways to, define how the drag can be exercised, agreeing on at what price can they be dragged is also something that you can do. But I think, as Darren said, try and avoid getting there anyway, use some of the mechanisms to enable the investor to leave. The tag along, I don't think is a very controversial clause. I think basically what the investor is saying is that if you're selling at X price, I want to be able to tag along in this sale. For you as an entrepreneur, what you need to do is make sure that whoever you're pitching to buy your shares understands that. Because some people, you might be going there to say you're selling your shares and you've not revealed to them that they'll have to buy everyone else's shares. So I think that's the only thing I would mention about a tag along.
Great.
Actually, I want to add one more thing on the drag. So Martha mentioned ways of mitigating the drag or negotiating your way out of it, or options that you can have, right? Another option that you can have is where there's this management buyout or company buyout and a fixed price. You can agree to a price that is sort of amenable to the investor, an IRR or whatever. And if you as a company, as you've scaled, have offered that price to the investor at some point, and the investor chose not to accept it for whatever reason, because they probably felt there's a further upside, the business may list, etc., then in many cases the investor should lose the drag option, because the business has actually enabled an exit for the investor. The investor chose not to exit at an agreed price as well. So sometimes you can add that into your term sheet. Obviously, it will get negotiated, and investors would want to hold the drag option even after you've offered the exit, but you can go down that path as well.
Okay. Great. So just a reminder to everyone, if you have any questions, please feel free to put them in the chat box. But there was one by Anita, which Darren answered, but I think it would be important for all the speakers to come in on, is would you advise a vesting schedule then, for good and bad levers? So I'll start with you, Martha. Would you?
Sorry, just repeat the question.
Would you advise having a vesting schedule for good and bad levers? For instance, detailing what causes the founder to leave. So sickness, etc.
Yes, I would definitely advise vesting schedule and definitions of good and bad lever. Usually the hotly contested one is what is bad lever. So trying to narrow down what bad lever is, obviously is for your benefit, but you need to understand why that clause is there. It's not, ideally the scenario should not arise that you're being punished and you're being exited at a value that you didn't want because of a bad lever scenario. So focus on those, focus on putting in good lever definitions such as, terminal illness or death, so that at least your family is able to get value for what you worked so hard for. So definitely I advise on that.
Okay, and then there is another question around, what have all your experiences been in integrating impact-related considerations in termsheets?
So I'll speak for myself. We don't set out goals and metrics in there. What we have in the term sheet is that because we are investors that have money from LPs that have to enforce that we follow ESG guidelines, we mention in the term sheet that the company will adhere to ESG guidelines, will adhere to exclusion lists provided by IFC, World Bank, CDC, etc., and will conform to all of those. And those may be detailed down in the definitive agreements, but they're not things that we already don't know about the business, right? So if it's a business dealing with alcohol or dealing with firearms or employing child labor and stuff like that, it's a business that we will not touch anyway, right, as an impact investor. So these are very not hotly negotiated clauses, but we, as an investor, as a Wishkar, we have a clause related to the founders being company conforming to ESG guidelines.
Mm-hmm. Mary, could you speak on the greenhouse capital side? Is this something you include?
Not really. We're not impact investors, but I can say from my prior experience when I was in a startup that was an impact-focused startup, often the way that will be included is more so through like milestones. So we didn't really touch on it too much during the session, but another way that investors might try to kind of secure their investment is by having milestones in tranches, where the deal might be $100,000, but they'll only do $25,000 up front, and then you have to meet certain metrics in order to unlock more levels of capital and to reach the kind of full total. So I have seen impact metrics kind of be used in that way within milestones. We at Greenhouse don't use impact metrics within our milestones, but we will have more so like commercial metrics sometimes.
Right. Got it. And then I'll go back to Martha. So when does a startup ask the shareholders to actually waive their right of first refusal? And would it impact the investor in any way?
Once you have the right of first refusal in there, getting them to waive it could, is obviously a discussion. It depends. I'm not sure what the context for the question is, but of course, from an investor perspective, if they have a right of first refusal, maybe the reason they want it in there is that they want to control who can become their fellow shareholder. So asking them to waive that might be a bit difficult unless Roger gives me some context as to why they would want that waived.
So he's just providing And he says, for instance, that the startup actually needs to fill an urgent cash gap.
Well, if the startup needs to fill an urgent cash gap and it cannot access capital from the immediate shareholders, they might be advised. An investor would probably say, then why don't we go for a bank, for instance? Because I know investors usually will look at equity money coming in very carefully, and they might not waive it because of urgency. They might say, then let's take a loan from a bank. And then carefully look for another investor to come in if none of us can finance it, who can then pay off the bank loan. So that's what I would see. But of course, if you're able to convince an investor that somebody else coming in is beneficial for all of you, then they probably would agree to waive it. Maybe Darren would know on what grounds he would waive that. You can pitch in.
Yeah. So Roger, sorry, I think in most cases this clause really doesn't get waived off for the reasons Martha mentioned. Investors are very picky on who else comes into the company in terms of the cap table, and especially because this is a secondary sale, right? This is not a new issue. The ROFR is not a new issue. This is a secondary sale by the founders. The founders are selling some part of their shareholding in the market, and therefore it becomes all the more important to know who else is, who this founder is selling the shares to. Now, if you're talking about the urgent cash gap for a founder or the startup, then the founder it's two different things, right? If there's a cash gap for the founder and there's expenses at home or whatever, then there are obviously accelerated ways to provide that cash gap, whether the investors can buy out the shares or we find an accommodative buyer. That's what we could do, or as Martha mentioned, go to a bank or raise some bridge financing to close the gap. I don't see the need for founders to sell their shares if the company needs capital.
Mm-hmm. Great. And then I'll take this from an East African perspective and West African perspective. So Wanjoy asks, have you seen the liquidity preferences actually kick in, or rather in local term sheets? And how can that be handled? Meaning, how can that be negotiated? I guess we've sort of touched on this, but if you mind expounding, maybe Darren, we start with you from an East African perspective, and then we'll go to Mary.
I think the industry standard for liquidation preference is 1x. Anything above that is probably detrimental to the startup, but the investor probably has a reason for doing that. There's certain risks that the investor is taking that are really high, and there's need for the 2x or 2.5x or whatever that number is. But the industry standard is 1x. I wouldn't know any investor asking for more without there being considerable high risk.
Okay. Mary?
Yeah, from my perspective, I have not seen higher than that either.
Okay.
On the West African side.
Oh, sorry. Martha, do you want to weigh in on this as well?
Same thing. Usually have seen 1x in Kenyan transactions.
Okay. I think that being said, if you do have any other questions, please feel free to reach out to Darren, Martha, and Mary directly, through the Brella platform, or, you can chat them now, directly. And if they're willing, they could share, their contacts with you. But thank you so much, everyone, for joining us for the session. Thank you, Darren. Thank you, Martha. Thank you, Mary. It was such a pleasure having you all in this session. And we'll be posting all this in the Brella platform. And the StankUp YouTube platform as well.
Thank you so much, Masi. Thank you, everyone.